Good morning. Welcome to Windsor Brokers live daily market outlook for Tuesday, 18th of October 2011. The markets are still under pressure after yesterday's comments from German Finance Minister Schäuble, who actually poured the cold water over the investors after initial extremely positive sentiment on the comments of finding a final solution for solving the Eurozone debt crisis and taking Greece out of the current deep problems, who said actually that the meeting on 23rd of October, the Eurozone officials meeting, will not actually produce a miracle cure for the current problem. But however, they are working on this, and actually there was a warning that of further reversal of the markets on these comments and generally on the current situation in the Eurozone. I would say that initial comments were a bit too optimistic. However, no one gave any detailed plan for this. It was just a sort of idea, but made a extremely positive sentiment in the markets, pushing the euro higher, that posted yesterday a fresh 1 month high. After comments of German finance minister, the things turned the opposite direction, and euro is still under strong pressure, with the latest recovery overnight still being capped under 38, and as we can see currently, the euro is descending and testing the previous support at 137.20. That might increase risk of further decrease of the single currency. The sterling remains quite supportive. However, the clear break above 158, which currently caps the upside, is still required to resume the broader uptrend. Dollar yen is back to weakness after failing to break the 77 and the main trend line resistance. However, we are going to talk about technical points later on in our technical part. Also, just to mention that China's economic expansion slowed in third quarter. That data released earlier in the Asian session showed its weakest growth pace since early 2009, with the quarterly GDP showing a drop to 9.1% from the previous second quarter at 9.5, and the forecast at 9.3. This puts also additional pressure on commodities, as the gold already is moving lower, based on the pressured by negative releases from China, as well as crude oil, while euro is also affected, as China is one of the Eurozone main trading partners. So these are actually another series of negative news that are coming over in past 2 days, and actually turning the recent short-term positive sentiment of the markets. Also, full calendar today. After Chinese GDP that we already mentioned, we have CPI from UK due in approximately 20 minutes. Yearly inflation is expected to grow to 4.9% versus the previous release at 4.5%. RPI, retail price index, also is extending higher to 5.4% versus 5.2% previous one. As well as core inflation coming expected at 3.2% compared to 3.1% previous release. At 9 o'clock GMT, German zoo economic sentiment also expected to deteriorate to come worse, as minus 44.8 is forecast for today compared to the previous release at minus 43.3. At the same time, we have Eurozone economic sentiment also expected into more negative area. Minus 45.1 is today's forecast compared to minus 44.6 the previous release. Across the ocean, US PPI on the monthly basis, expected to raise by 0.2% compared to unchanged the previous release, while core PPI monthly is expected to stay unchanged at 0.1%. And the housing market index later in the afternoon at 1400 GMT from US, it's forecasted at 15 versus the previous release 14. Also, we have speakers today. Bernanke is due at 17:15 GMT, while Bank of England Governor King is due 15 minutes later, so 17:30 GMT today. Now let's take a look on the technical outlook for the currencies and see what are the current movements in the market, since situation is changing from the European opening. The euro is sharply lower. As we can see, the euro posted yesterday high at 139.13. This is a fresh 1 month high. However, the failure to hold against above 139 level, as well as under our key resistance at 139.35, 15th of September high, has triggered the reversal. The first leg hit lows at 137.23, just ahead of 137.20, 137 previous high support, and the key break point at 136.85. That is coming now under pressure. Actually, the initial recovery was capped under 138. And this fresh weakness now is attacking 137 zone and possibly 136.85, which is our key support. This is the previous high of 10th of October and the low of 13th of October, and this could be risky for the near-term outlook for euro-dollar, as it might weaken the structure, and on the loss of this level, weaken the structure and extend the losses further down. Break below 136.85 opens Fibonacci level at 136.20, which is 38.2 of 131.45, 139.13 up leg, and this would actually put the near-term bulls on hold in favor of stronger reversal. Important support, a very strong level actually is at 135.65, below which could be quite risky for the pair, and this would sideline actually it might signal the end of the corrective attempt from 131.45, as the broader outlook still remains bearish from 145 pardon 49, with the recent bounce from 131.45 seen corrective, and the immediate cap comes at 139.35, the 15th of September high, and the daily 55 days moving average currently at 139.40. So this zone is actually capping for now, and the loss of 135.65, the support before mentioned, might risk forming a confirmation actually of the double top ahead of the fresh weakness. Daily 20 days moving average also at this area at 135.33 offers another support. As we can see, the daily studies are still below their midlines. There was some build up in the momentum recently on the yesterday's move higher. However, the studies are all currently pointing lower, and this would be risky. Also, the 90 days moving average is currently attempting to break below 20 days moving average, along with 55 and 20 days that already broke below, creating that cross and signaling further weakness of the pair. The sterling was in recovery mode after a pullback from 158.51, the low posted on 14th of September last Friday, and yesterday's 158.47 failed actually to sustain gains here, and test 158.65 and 159.00 on the break. Initial pullback was found support at 157.30, just ahead of 157.20, 157.00. The previous the strong support. However, the upside gains remain capped under 158. Actually, there was a brief break to 158.21, but failed to sustain gains, and currently is in the near-term downtrend. Immediate risk now comes at previous yesterday's low at 157.30, below which comes 157.20. So we have initial support 157.30-20 zone, and then 157 ahead of break point at 156.85, which is the low, 156.65, pardon, the low of 13th of October, and 156.85, the high of 10th of October, loss of which would be risky for the pair, would trigger some stronger reversal and put immediate bulls on hold. Reversal above 157, 157.20 would still keep the short-term bulls in play, and as we said, above 158.50 to open, 158.65, 159, and then above this we have 159.40, which is the Fibonacci 50% retracement of the broader downtrend from 166.17 down to 157.21. Congestion here needs to be cleared in order to resume higher, with the 59.40 as Fibonacci level coming next. The hourly studies are still, daily studies are still in the negative territory and still pointing lower, with both 55 and 90 moving averages currently below 200 days moving average, and keeping pressure on the pair, with break above 159.40 and initial 159.74, 55 days, and 160.39, 90 days to improve, and the open way for test of the key resistance zone on the daily chart at 161, which is the 61.8% Fibonacci retracement, and the 161.34, 200 days moving average. For the time being, the short-term outlook remains positive, while the 157 2030 zone holds the downside. The dollar yen is back under pressure as repeated attempts higher to clear the 70, to sustain breaks actually above 77 were capped by descending trend line from 85.51, the April 2011 high. And while the upside remains capped, the immediate focus is to the downside. Loss of 77 as initial resistance, initial support, pardon, and break below the previous support at 76.67 has so far seen 76.59, with immediate tone still focusing the downside as the 4-hour chart 20 days moving average pointing lower and capping the upside at 77. Also, the studies are turning to the downside, and the loss of momentum might risk a test of 76.59, and below this 76.30 is our next level. On the downside, key supports are 76.10, 75.93 unchanged for a past over 2 months, as the pair remains in the directionless trading, with the limits on the upside at 77.40 and the downside at 76.10. So break of either extreme point would signal the fresh direction. The daily outlook remains still entrenched within the range, with studies nearly flat, however holding below their midlines. So this keeps the slightly negative sentiment favored at this point. Dollar Swiss trades in a corrective mode after breaking a reversal from 93.13, the fresh high of 6th of October. Lost the initial support and strong support at 89.20, also losing 89 as a round figure support, and dipping down to 88.80, which is the low of yesterday, ahead of current recovery attempt. So far, the near-term outlook remains positive, but 90, 38 levels are still capping the upside, with sustained break above here to ease the current bear pressure and open way for further recovery. On the upside, we have on a break of 90.38. We have 91 as a round figure, and then comes 91.20, the previous high of 11th of October, and 91.40 zone lows of 7th of October and 5th of October. So actually our key barriers are at 91.20, 91.40, above which would definitely confirm the extension of the end of the corrective dip down to 88.80 and the return focus up towards 92 and 93 on a break. On the downside, if failure to clear 90.00, 90.38 keeps the risk to the downside, and below 89.20, 88.80 lows would risk further extension downside, and the test of first trend line support, the main trend line of 70.67 record low, which currently stands at 88.50, and then we have 88 as a round figure support, and 200 days moving average at 87.65, below which could be bearish and might weaken the overall positive tone from 70.67 record low. The commodities were affected by recent developments in the market, as gold that was initially capped by 38.2% Fibonacci retracement of the broader downtrend from 1920 down to 1532. The upside remained capped under 1700, our initial barrier, with current pullback through the short-term trendline support drawn from 1532 low and connecting through 1597 low. Current break below this softens the near-term tone, as currently the 20 days moving average on the hourly chart maintains the negative tone. A loss of initial supports at 1675 and 1666 has so far extended down to 1661, with the 1660 now in focus, ahead of a key support at 1650, below which I would say would put the upside attempts on hold and the open way for a further extension 1626, and the loss of 1600 would definitely turn the focus down to 1532, retest of the low of 26th of September. On the upside, only regain of 1695, 1700 and firm break higher improves the near-term outlook and signals resumption of the corrective uptrend from 1532, the low of 26th of September. The crude oil is currently in the trading in the corrective near-term mode after hitting fresh high at 88.38 yesterday. As we can see on the 4-hour chart, the strong near-term uptrend from recent low at 74.94 posted on 4th of October remains still intact despite the brief break of the main trendline support. It's significant that market is attempting now at 85.93, which is the 4-hour chart 20 days moving average, and holding above this one keeps the immediate positive tone in play. Studies are pointing lower, so we might see some deeper reversal towards 83.37, which is our main short-term support, and below here actually it would put the immediate bulls on hold in favor of deeper reversal. A reversal above 83.37 would keep this near-term uptrend intact and open way for retest of 88.38, above which comes 90 and 90.57, our next strong resistance zone